Hello there, and welcome to our Lots of Pips training program. My name is Jared Passy, and this section is on our Forex skills overview. We're going to kind of get the whole picture. How does everything fit together? Some of the bigger pieces, and some of what you'll need to, commit yourself to learning and understanding pretty solid before you want to go and putting a lot more effort into, or a lot of money into trading foreign currencies. So let's get started and take a look at what all you need to know. And this is it. There might be a couple things I missed, but this is it. All you got to do is have a good solid understanding of all these things, and you'll be good to go. Trade management, we'll be talking about that in this video here. Different chart patterns, different things, and so. But I don't want this to seem too bad, because if I had this sheet for a dentist, it'd probably be quite a bit more. So I think you're good. This is doable. Don't let it overwhelm you. But I do want you to not go into this, blind. I want you to understand that there's a learning curve to this, as with any, profitable endeavor. So we'll be touching on some of these. We've already touched on some of these, many of these in earlier segments, and in the whole training programs we get into in depth on all these and more. So all right, let's move on here. Let's give you a little outline of our overview videos. The next three videos will be in this section of the overview, and first thing we're going to talk about is analysis, skills and tools. Analysis is how we determine and find clues to letting us know which way the market's going to go next. Okay, that's all it is. All we're trying to do is figure out which way a currency pair or the market is going to go next. Once we figure that out, we can figure out where to get in and where to get out and make some money. But that's the analysis. We're going to be talking about charting software. We're going to talk about technical analysis, which is all about charts and things like that. And we're talking about fundamental analysis, which is about news and announcements and the other factors that manipulate the market and get things to move. We'll also be talking about money management, because that's really important, including trading psychology, right, which is very important. If you don't have your head in the right place and you're playing defensively, or you're more aggressive, or things like that, you're trading on revenge, you'll get messed up. And we'll be talking about some planning and journaling and some of the things that you need to, create as habits to be able to, prosper in this market. So starting off with analysis, skills, and tools, we have our charting software. A lot of brokers out there, matter of fact, I think all of them now, I don't know any that don't, will give you the charting software. Now this is great, because when I started trading currencies 10 years ago, I had to pay $120 a month for my charts. For my chart feeds, I had to pay $120 a month, and that was normal. Okay, and then the brokers came up and started competing with one another, and they all started offering the charting software for free, which was great, especially when you're learning and you're using a demo account and you're paying that each month while you're learning. You're not even making any money trading. So lucky you, your charting is free. We want to, in our charting software, we want to understand different time frames. So you have charts that show 5-minute charts, which show every candle represents 5 minutes, or a day, or a week, or an hour. You can adjust your time frames on your charts to reflect what scale you want to look at, and you need to be aware of and use these different scales to get you the different pictures that you want. For how the market's moving. Charting software should include a lot of drawing tools. Okay, tools you can draw trend lines and Fibonacci's and different blocks and targets and indicators and stuff. We also have all charting softwares have indicators, whether they're custom indicators or set indicators. We'll get into that in a little bit into this section here. Also, where to get your charts. Well, easy place is to type in Forex broker online and find a broker that fits your criteria. We've got in our training more in depth, we do a little bit better in focused what you need to look for in a broker kind of a thing. MetaTrader charts are the most used charts. Most brokers offer MetaTrader charts. Some of them offer their own version of charts. Some of them offer both. But MetaTrader is the most understood, and that's what we use for all of our demos, examples, and what I use in my trading as well. And that's offered through my broker, who I can't tell you who it is because then that would be a recommendation. Most brokers offer free charting software. We talked about that. So that's a little bit about the charting software overview. Let's get into technical analysis. Okay, technical analysis is the largest skill set in the Forex. Most people spend most of their time studying how to read charts, how to participate or how to predict different movements, how to recognize patterns. Because if you can recognize a pattern in a chart, and you can then determine a predictable level of probability for that pattern to repeat, then you can tell where the market's going to go next, which, like I said earlier, was the key of this market, of this endeavor, is to try to figure out where the market's going to go next. You also have combined signals. Now, a combined signal means that you have a couple different reasons that tell you why the market's going to go next, where the market's going to go next. One of my rules we talked about in some of the basics training is having trading laws and trading rules, is that I won't enter a trade unless I have at least 3 reasons that I can see that the market's going to go in a certain direction. So I need some confirmation. I need combined signals. And these are some of my, over the years I've figured out what to use. And these are some of my probability indicators. These are the pieces of the puzzle, the clues that I put together to combine signals. These each give me a signal of one kind or another. When I combine those, I can create strategies, and I can determine, where the market's going to go. There's a higher probability. I only trade trades that have a higher probability of success, and if I can't find those combined signals, I don't trade. The first one is chart patterns. Your double tops, your double bottoms, your head and shoulders, your Elliott wave, which is over here, because it's in its own world. Chart patterns. So if I see a chart pattern, and there's candlestick patterns out there that we haven't gone into, but you can use different patterns, different ways candles form are predictive of what might happen next or what the market's doing. There are hundreds and hundreds of indicators. You can even create your own indicators to tell you what the market's doing or give you some clues. I don't rely a lot on indicators because mostly they're lagging indicators, and we'll talk about that a little bit. They basically show you the past but won't give you any indication of what's going to happen in the future, which is, I can't trade on the past or I'd be richer. Volatility, volume in the market moving is a key element. That goes right along with timing, volatility and timing, market timing over here. When the market's overlapping, the euro market and the US market are overlapping, you're going to have more volatility because there's more people trading at the same time. So things are happening and news events coming out, things like that. Market exhaustion, I use that in a couple different strategies where you see the market climbing and climbing and climbing and climbing. And if you'll remember, I kind of favor the fading side of trading. So that means that I want to recognize when the market's going to change direction. And if the market's gone quite a bit further than it normally goes, then I'm guessing the market's exhausted, and I'm looking for barriers in places like these, Fibonacci price levels and price barriers, pivot points. These things I'm looking for to find a place where the market's most likely to stop, run out of gas, and turn around, and I can capture some pips in the retracement. And then, like I said, Elliott wave is the granddaddy chart pattern, and then we have market timing, which we talked about, and then trends and trend lines. This is my bread and butter. Understanding trends and trend lines are a key element to figuring out when the market's going to change directions. Once you've got a confirmed trend line breakout, that's a great indicator if you have the right clues and the right rules lined up of the market changing directions. And if you can determine where the market's going to change directions, you've got a pretty good idea where it's going to be going for the next little while or the next long while. And so that's a lot about our technical analysis and some of these indicators and tools and lines here. All right, here's an example. We've got a double bottom chart pattern. The market's been moving here. It drops down, tags this line here, pokes through it a little bit. Each one of these gray lines represents 50 pips. Okay, it comes back up, and then we come down, and it hits it again, but hesitates. Okay, when I see this, and I see a long drive down, and I see this really strong pull back up, I'm going to be looking for it to go hit again. So I place a trade right here on the purple line. I put a 50 pip stop loss down here below to where if it goes 50 pips, I am going to get out. I only want to risk 50 pips on this trade, and then I go ahead and place a 500 pip take profit up here. So 500 pips above that, I'm going to place a take profit, and it's my expecting it to get back up to this price point that it was at earlier. So that's 500 pips. I'm risking 50 pips to make 500 pips, and that's what's called our risk reward. Whatever strategies you do and whatever things you do, I've worked with hundreds and hundreds of students, and I've had a lot of them come in and show me strategies they figured out or they learned that have an upside down risk reward ratio, but they expect to win most of the time, so that's okay. So what I mean by upside down risk reward ratio is they're going to risk $100 to earn 50. Okay, but they're going to win 90% of the time, so it's fine. Well, that doesn't work. I'm gonna put that out there right now. It doesn't work. Don't ever trade a strategy that's got an upside down risk reward ratio. And these double bottom patterns have some of the largest risk reward ratio, positive risk reward ratio out there. Because you can risk a small amount, percentage wise, 50 pips to go for 500 or 200 or things like that. One of my rules personally is I generally only look for trades that have a 2-to-1 risk reward ratio. If I'm going to risk 50 pips, I'm going to expect the market to get at least 100 pips out of that trade. All right, so here's a mathematical example. If you have 10% if you have $10,000 in your account, and you multiply that by 2%, which is what you're willing to risk, and that's just a number I'm using for math. You determine your own risk tolerance. We'll talk about that. Okay, 2%, that equals $200. You're risking $200 is what you want to risk. If you have a 50 pip stop loss, okay, we'll talk about money management where all these numbers make sense. But if you use a 50 pip stop loss, then you can trade 4 lots. So 4 mini lots means that if you lose 50 pips, you're going to lose $200. So you can determine exactly how much you're willing to risk at any time. So if you say I only want to risk 2%, then I should only trade 4 lots with a 50 pip stop loss. 4 times 50 is 200. So there I have $200. But 4 lots times 50 equals 200. That's what I just said. Risk 4 lots times 500 equals $2,000 profit. So I've got a 10-to-1, obviously 500 pips, 50 pips. I am risking $200 for the potential to make $2,000 profit. Okay, how many times do you need to be right to make this a profitable strategy? Okay, if you're right half of the time, are you still making bank? Yes. If you're right a quarter of the time, you're still making money at the end of the month. Okay, you may lose 75% of your trades, but you're still making money if you have a positive risk-reward ratio. Okay, because things don't always work out to winning the right amount of trades. That's why we always have a positive risk-reward ratio. All right, candles. Candlestick charts are the most common. We can use candles to tell us net gain. Okay, we talked about candles a little bit in the earlier one. Net loss, time. Okay, each of these candles represents a certain amount of time. Extreme high and extreme low. And the market sentiment, which way the market's traveling. Up, down, right, left. That's what we can use candles to tell us. So we're going to move on in this. We've got a more in-depth training on candles and candlestick patterns in the actual training program that we have. All right, indicators. This is an intro to indicators. There are hundreds, if not thousands, of indicators that people have created out there. Some of the most popular, most reliable indicators are here. The ones that I use or have used. Moving averages are a big one. These are moving averages. They're calculated based on the close price of each of these candles, and it takes into account how many candles back you want to measure from, and it puts an average for the price. So this purple line is a lower segment moving average, which means it takes fewer candles into account, and the green line is a higher level moving average. And what happens is people trade based on when the green and the purple cross. So when the purple's on top, that means we're kind of in an upward trend. Well, when it changes over to be on the bottom, that gives us an indication that we're changing into a downward trend. And sure enough, they cross here and we keep going down in this downward trend. Okay, so that's a moving average. MACD is similar. It's not on the chart with your candles. It's down here. It shows a couple different things similarly. These won't make sense to any brand new people, but this is just a preview. A couple others, Bollinger Bands are interesting. They show a center line that kind of it's kind of like a moving average, but they also show these expanding bands that contract as the market's going flat and level and start expanding with volatility and volume. So as the market increases, these Bollinger Bands expand out, and people trade based on when they break out of the bands to ride them back in or change directions, stuff like that. The RSI measures relative strength in the market. So as it's sitting here at nothing at 50, then that shows that it's not really, being very strong. As it pops up to 80 or down to 20, that shows we've got stronger buying pressure or stronger selling pressure as it goes above or below the 50 mark line. And then we have the the parabolic SAR, which is another one that shows trend change in direction. All right, and then we have with little dots, and then we have the ATR, which stands for average trading range. So this one here on the pound yen, the average trading range for a 5-minute, his candle is 125 pips for this on a regular day. So the regular day shows basically how much the charts move on average. So if I looked at a different chart like the euro, it would be less because the euro generally moves less or has less volatility than the pound yen. And we can use this tool to give us an indication of we're really overboard. All right, so then you can also do custom indicators. Here's I use a custom indicator to show me my psychological barriers. Puts gray lines on my 00s and 50 lines and stuff like that. I also use a custom indicator to put time blocks on here. This is the start of the European session right here, and then this is a level where they're the start of the U.S. session, and they're overlapping about the middle of here, and then this is where the volatility dies off in the morning. So you can see that things kind of flat, then they wake up during this time, got some volatility, and then they kind of go flat again until in the afternoon when things start picking up because of the Australian and Japanese markets. So those are some custom indicators, and that's kind of it for indicators. All right, trends. Upward trends, we talked about this in the earlier video, defined on a chart by the chart making higher highs and higher lows. As long as this is making higher highs and higher lows, we're in an upward trend. As soon as it changes and starts making lower highs and lower lows, then we're in a downward trend. And if it's not doing either, then we're in a sideways channel. And things are obviously different scales and times as well. All right, so charting tools. Another one is these drawing tools is like trend lines. So I told you about trend lines. The markets seem to like to line up on these trends. And so touches here, touches here, touches here. So once you have 3 points in a row, then you can put a nice trend line on there. You can do it on 2, but they're not as reliable. I only use trend lines that have at least 3 points. at least for placing trades. And then when I'm looking at a downward trend, I'm paying attention to when it's going to break out and change directions. So I see that it broke out here, so I can anticipate it broke out of that trend, so we're changing from a downward trend to an upward trend, and sure enough, we made a higher high here, so we're going back up. I'll expect this to kind of hover or retrace a little bit and continue up. We also use chart patterns like the Elliott wave, 1, 2, 3, 4, 5, A, B, C. You know, we might have a head and shoulders here, go down for a shoulder, there's our neckline, down for the head, up for the neckline on the backside. I'd expect something down around this range to continue, so I'd be looking to place a trade right around here to go long for the next move up. So that's an example of a chart pattern. We also use Fibonacci lines for part of our drawing tools and our chart tools. You draw a Fibonacci on a completed move, and then watch how this market responds to these different specific Fibbo levels. These three, 38, 50, and 62 are the most reacted to, most common lines. We also have 23. So the market comes up, stops at 38, comes back down, comes up, stops at 50, comes down, bounces off 23, goes up and bounces off 62, come down, bounces off 23 again, 62, down to 38, up to 50. So the market bounces around between these lines. So having these lines on your chart and seeing what's going to happen might give you an indication of where the market's going to stop or move. And there's plenty more tools and things out there that you can use for drawing objects and stuff that I don't have time to go over in this overview. But just suffice it to say that there's a lot of tools that you can play with and get used to and use and figure out how you can predict where the market's going next. So analysis skills, fundamental analysis. This is the your degree in economics. Banks and large institutions, they trade a lot on fundamentals. They're all balancing out what news announcements and jobs rates and employments and politicals and elections and housing sales and all this kind of news and stuff. And they're more interested in, or people that trade fundamental analysis are more interested in the when things are going to happen versus how or why. Well, they use the why a lot too, but let's just say they don't focus as much on the charts as they do on, or they focus a lot of time on the fundamentals, the news, and the economy. We use economic calendars to determine when announcements are coming out and what's going to happen with them. We also are hit with unexpected events, right? 9/11 hit the market pretty strong. Hurricanes that make the government spend a lot of money to fix, hit the market. When the bombings happened in London several years ago, that hit the market pretty strong. Just different things like that that are unexpected. And so that's some fundamental analysis, and that kind of wraps up that first section here. Be sure to watch the next one in the series on money and trade management. It's shorter than this one, so you'll get a little break. But it's very important. Money management and trade management, what to do, how to stay in a trade or when to stay in a trade. So good luck. We'll see you on the next one. Thanks.